And I want to share with you some things to consider when you are assuming a loan. So I have some clients who are buying properties with loan assumptions. Now, these loan assumptions are very enticing because they are much lower interest rates. The sellers got these loans when the rates were down in the 4%. And so now the people buying the house or buying the property get to take over that loan and keep that interest rate. And I want to share with you some things to consider when you are assuming a loan. The first one is how much is left to pay back on the loan. The ideal scenario is if the seller had recently bought that property and there's only, they've only paid into it a couple of years. So the loan is going to still be fairly large, which means you don't have to bring as much to the table in order to close it. Say you're buying an $800,000 house and it has a assumable loan on the property at 4%, which is awesome. That is, half of what some people are paying. And say the person selling it had bought that house 10 years ago and just had refinanced the house with the, selling it for 800,000. So you're not going to take out an $800,000 loan or even 700,000. There may only be like 400 or 300,000 left on that loan, or less. Maybe there's only 100,000 because when they bought it was way lower priced. So that means that your 4% loan is only going to be on that 100,000, and you're going to have to bring another 700 to the table, which you'll have to probably take out another loan for unless you're paying cash. So that is, decent. That's not bad to get a $100,000 loan at 4%. That's pretty awesome, but you're going to find out in a second why you may not want to go for that.